Chapter 4, the income statement, comprehensive income, and statement of cash flows. So this chapter has a couple of main purposes. First is going to be considering important issues dealing with how content, presentation, and disclosure of net income and other components that make up comprehensive income kind of interplays with each other. And secondly, providing an overview in general and maybe slightly more specific than in the past of the statement of cash flows. So the statement of cash flows gives information about profit-generating activities that occurred for whatever time period that the statement says on its face. So unlike the balance sheet, we are interested in anything that we are not interested in anything that's carried over from the last period. So we're basically starting from scratch. Because of this, sometimes investors, creditors, and other external third-party users of these financial information, financial statements, view it as the financial statement that can best indicate stability. The statement of cash flows describes how operating, investing, and financing activities affect cash for whatever entity you're talking about during the given time period. The income statement and statement of cash flows are referred to sometimes as change statements because they show how the things they're reporting on have changed over a time period. The balance sheet is something called a position statement because it shows the financial position at a given time period, or a given point in time rather. So for a position statement like that, for like a balance sheet, in order to see how the statement has changed, you would have to compare two of those statements, one from, for instance, maybe a previous year, and one from the current point in time, and compare it that way. Whereas if you're looking at an income statement, you are seeing how those revenues and expenses and net income, how that occurred over that given time period. So the first section of the income statement includes income from continuing operations. The components of income from continuing operations are revenues, expenses, including income taxes, gains and losses, excluding those related to discontinued operations. We've talked about, and you should be familiar with what revenue is, but to refresh your memory, revenue is money earned from providing goods or services to customers. This is your core business. You could be a car guy or an accounting services gal, or whatever your main business is. When you earn money doing that business, it's called revenue. And expenses are then basically things that you had to pay for or you incurred debt for in order to generate those revenues that we just talked about. If you can know for sure which revenues each expense that you have helped to generate, you will match the expenses, those expenses that you know of their specific tie to a revenue. You'll expense those in the same period that the revenue that they're tied to is recognized. So that's not always possible. So when that's not possible, you will try to allocate to either one or several periods using some systematic approach to allocating these expenses, something that makes sense and can be shown to systematically tie them, even if not specifically, in general, to revenues that they help to earn. And obviously there is an option of expensing immediately, and that will sometimes happen as well. Gains and losses that are not part of revenue and expense, but still at least kind of tangentially connected to normal business operations, are included in income from continuing operations. So you see there some examples of that, or at least an example of that. Routine sale of equipment, buildings, or other operating assets, and from the sale of investment assets. This is just an example entity that is referenced throughout the chapter, and you see the income from continuing operations section of the income statement. In general, there are two format options for the income statement. You have single step and multiple step formats. For single step, you don't classify operating and non-operating income separately. For multiple step, you do classify operating and non-operating as separate portions or steps of the income statement. So here we have a single step, and here we have an example of a multiple step. Since one of the main purposes of financial statements in general is to have some predictive value of a company's current and maybe future financial health, often the term earnings quality is used or is discussed. And this basically is a term that, well, because of this term, basically you'll divide earnings into two separate categories, or someone who's evaluating financial statements will do that. And in this case, we have a transitory earnings category and a permanent earnings category. The transitory earnings category is generally the category that an evaluator of financial statements would think or would say is something that is not likely to occur again in the future, or that perhaps could have a different effect in the future on earnings. Permanent earnings would be the category that is likely to continue into the future and more likely to impact future performance. Sometimes within, even if you're using the correct framework of GAAP accounting rules and complying with the letter of the law, there are sometimes just in place incentives that serve to incentivize executives to kind of doctor the books within acceptable boundaries. So kind of on the surface, you're not violating any GAAP accounting rules, but you're taking advantage of some flexibility in the rules to kind of misrepresent what the financial statements are presenting. So there's a couple of techniques for doing that. We're not going to spend too much time on that. But I think it's important to remember that these incentives sometimes exist because for an entity, you see that kind of having a smooth upward trend to the earnings is looked at more favorably than, kind of up and down, up and down. So even over, if the performance is the same over a 5-year period, but one is a smooth upward trend and another is kind of up, down, up, down, up, down, the smooth upward trend is going to look better. So there's an incentive there for decision makers to try to make their books and their earnings look more smooth. And if they can do that while staying within the framework of GAAP accounting rules, sometimes they do. So now we're going to talk a little bit about dealing with discontinued operations. So generally, when dealing with discontinued operations, the liability and expense of those operations are recorded at the point in time that they are deemed to have been incurred. Obviously, within accounting, the recognition of liability and expense is a big part of, when that is recognized, plays a big part in accounting for this particular component of a business. Costs associated with restructuring or discontinuing operations can be pretty significant. Sometimes these require making future estimates. Obviously, sometimes estimates are wrong. So if a correction is made or needs to be made, it's generally made in the period where the change occurs and not backtracked to prior statements. Some other unusual items that we have to account for are goodwill impairments and asset impairments. These involve something that is referred to as impairment loss or charges for impairment. Any long-lived asset, whether it's tangible or intangible, should have its balance reduced if there is a known or obvious impairment that's significant to the value of that asset. So most of the time, most components of earnings in an income statement relate directly to the ordinary continuing operations of the company. But there are some, like interest and gains and losses, that are only somewhat related to ordinary continuing operations. These are called non-operating items. This illustration shows the non-operating section of Intel's income statements for the 2000 and 1999 fiscal years. In 2000, income before taxes increased about 35% from the previous year. But you should also pay attention to and notice the fact that gains on investments, net, which means net of losses, increase from $883 million to over $3.7 billion, which contained within that almost, slightly over 3.1 billion jump, a lot of the increase in income is contained within that. So some analysts obviously questioned the quality of the earnings for Intel in 2000 because of these gains on investments. For this reason, revenues, expenses, gains, losses, and income tax related to a discontinued operation must be removed from continuing operations and reported separately for all years presented. This is shown in this slide here in the highlighted section. You can use this chart to help determine the correct way to report discontinued operations. This is just an example of a disclosure note for discontinued operations of the Eastman Kodak Company. So we're going to talk a little bit about accounting changes. All accounting changes fall into one of three categories. These can be a change in accounting principle, a change in accounting estimate, or a change in reporting entity. Then on top of these changes, you also have something else which is similar in practice, and this is correction of errors that may have been made. These correction of errors are accounted for in much the same way as some other certain accounting changes. A change in accounting principle refers to a change from one acceptable accounting method to another. So this is not an error correction. This is going from one, basically you have a couple of options that are all considered correct, and you're changing from one to the other. Obviously, even this type of change in accounting principle is discouraged in GAAP because anytime you're changing anything in the way that you're reporting accounting information and financial information, even if you disclose the heck out of it and let everyone know the changes that you've made, there's still the danger that you're going to compare either 2 years of the same company or 2 similar companies and not take into account that a change in accounting principle has occurred. So you're at that point possibly comparing apples to oranges instead of apples to apples, which of course makes the reliability of the information a little bit more suspect. A change in depreciation, amortization, or depletion method is considered to be a change in accounting estimate that is achieved by a change in accounting principle. And the reason that's important is because these various different types of changes are accounted for slightly differently. So we account for this change prospectively, almost in the exact same way that we would account for any other change in estimate. One main difference is that most changes in estimate don't require a company to justify the change. However, this particular set of changes in estimate are the results of changing an accounting principle, and therefore, because of that, they require a clear justification as to why this new method that's been chosen is preferable. A change in accounting estimate is reflected in the financial statements of the current period when it's changed and future periods. Since estimates require you to predict the future, obviously they're sometimes wrong. When an estimate is modified because new information has come to light, accounting for the change in estimate is pretty, I don't want to say easy, but at least pretty straightforward. In that case, we don't revise prior year's financial statements to reflect this new estimate. Instead, what we do is incorporate the new estimate in any related accounting determinations from that point on. So we account for this change in accounting estimate prospectively. If the effect of the change is material, we also need to include some type of disclosure note describing the change and how it has affected both net income and also earnings per share. Error correction, again, is pretty straightforward, maybe not easy, but pretty straightforward. But remember, in accounting, nothing is ever deleted. So to correct any errant entry, you have to just do the opposite of that entry. So turn debits to credits, that reverses the entry, the erroneous entry, and then you just enter the right one. Obviously, you can't do that for a prior year without restating the whole set of financial statements that are affected by that. So you would only do that and take that step of restating prior year statements if the change or the error was considered material. If not, you just correct the error whenever it is discovered and move forward. If financial statements are published and have already been shipped out, distributed to shareholders, then a material error forces a prior period adjustment. For a prior period adjustment, the company would record a journal entry that adjusts any balance sheet accounts to what their levels should be and would account for the income effects of the error by either increasing or decreasing the beginning retained earnings balance in a statement of equity. Okay, so that should make logical sense because the balance sheet is tracking over time these changes, and the changes, obviously the balances and balance sheet accounts, roll over period to period. Since you reset the income statement accounts that are affected, then the way that you change it is just by manipulating retained earnings, because that is where the effect of the income statement is felt. Besides highlighting important relationships among financial statement variables, ratios also accommodate differences in company size. Earnings per share, generally referred to by the acronym EPS, is a ratio which shows the amount of income earned by a company expressed on a per share basis. Diluted earnings per share reflects the fact that potential dilution could occur for companies that have certain securities outstanding that are out there in public hands or in the hands of shareholders that are able to be converted into common shares or stock options that could create additional common shares when they're exercised. The creation of these additional common shares causes earnings per share to decrease because you're increasing the shares, right? So if you increase the denominator in a fraction, you are causing the fraction to decrease. That obviously is where we get the term diluted, because more shares in the denominator dilutes the EPS, or earnings per share calculation. Right here we have a fairly recent quarterly income statement of Big Lots Incorporated. If you're not familiar with Big Lots, it's the largest closeout retailer in the United States. When the income statement includes discontinued operations, as you see here, we report per share amounts for both income and loss from continuing operations and for net income and loss, as well as for discontinued operations. Comprehensive income is the total change in equity for a reporting period other than from transactions by owners. So other than owners either putting money into the company or taking money out of the company, comprehensive income captures all other ways that equity has been affected for a period. In other words, it includes net income as well as other gains and losses that change shareholders' equity but are not included in the traditional calculation of net income. Companies in general, at least GAAP companies, must report both net income and comprehensive income and then reconcile the difference between the two. Or in other words, show how you can get from net income or the calculations that get you from net income to comprehensive income. Now I know in general GAAP accounting can seem pretty rigid and can seem to lack flexibility overall. And I know this slide doesn't illustrate a ton of flexibility. However, the flexibility that is allowed in terms of income statement presentation is shown here, or in terms of the presentation of, I should say, comprehensive income items and income statement. Reporting comprehensive income can either be done with a single continuous statement or by using two separate but consecutive statements. Now I know that doesn't seem like a huge big deal, but it does change the way it's done slightly. Each component of other comprehensive income can be displayed either net of tax as a single component, as shown here, or there's another way of doing it, which is reporting them all before tax with one amount shown for the aggregate income tax expense or benefit. In order to further understand the relationship between net income and other comprehensive income, look at the example that's illustrated here. This example illustrates the reporting differences between two scenarios related to the sale and change in value of shares of Phillips Corporation stock. So a couple of notes about the statement of cash flows. The purpose of the statement of cash flows is to provide information about the cash receipts and cash disbursements of an enterprise that occurred during a period. Similar to the income statement, as we talked about a little bit earlier in this presentation, the statement of cash flows is a change statement. So it summarizes all the transactions that caused change to cash during the reported period. Remember, for the purposes of the statement of cash flows, cash and cash equivalents are both included. The inflows and outflows of cash that result from activities reported in the income statement are classified as cash flows from operating activities. However, it is important to remember that these numbers may not exactly match the income statement numbers that you would see, because in tracking inflows and outflows of cash, you are basically, by definition, looking at that from the stance of cash basis accounting. That's kind of the definition of cash basis accounting. Whereas on the income statement, you have items of inflow and outflow of earnings. Well, I don't want to say inflows and outflows, but you have revenues and expenses that may or may not be tied to inflows and outflows of cash. So it's going to vary slightly, and the degree of variance is going to depend on the timing of payments related to these revenues and expenses reported in the income statement. So listed here on this slide are the two acceptable ways of reporting cash from operating activities on the statement of cash flows. Cash flows from investing activities include inflows and outflows of cash related to the acquisition and disposition of long-lived assets used in the operation of the business. These typically include property, plant, and equipment, and investment assets, except those investment assets that are already included as either cash equivalents or trading securities. The purchase and sale of inventories are not considered investing activities. Inventories are purchased for the purpose of being sold as part of the company's general business operations, so their purchase and sale are almost always included with operating activities rather than investing activities. Financing activities relate to the external financing obtained by the company. Cash inflows for financing activities occur when cash is borrowed from creditors or invested by owners. Cash outflows for investing activities occur when that borrowed cash is either paid back or when cash is distributed to owners. Remember that the payment of interest to a creditor is classified separately as part of the operating activities of the entity. The statement of cash flows provides a lot of useful information about the investing and financing activities in which a company is engaged. Even though these activities primarily result in cash inflows and cash outflows, there may be significant investing and financing activities occurring during the period that don't involve any cash flows at all. So in order to provide complete information about all of these activities, any significant non-cash investing and financing activities in which cash is not exchanged, any of these that are significant are reported either on the face of this statement of cash flows or in a type of disclosure note. So one example of a significant non-cash investing and financing activity is the acquisition of equipment. This is an investing activity by issuing either a long-term note payable or equity securities, which is a financing activity. So it's kind of a hybrid there. The 2016 Statement of Cash Flows for Arlington Lawn Care, beginning with net cash flows from operating activities, is shown in this slide. When we talk about the differences between US GAAP and IFRS, there are more similarities, at least in terms of income statements, than differences when we're talking about preparing under US GAAP versus IFRS. However, there are some differences. Highlighting some of those differences, we have international standards that require certain minimum information be reported on the face of the income statement. US GAAP has no minimum requirements. International standards allow expenses to be classified either by function, an example of that is cost of goods sold, general and administrative, or by natural description, for example, salaries, rent, etc. SEC regulations require that expenses all be classified by function. And then finally, in the United States, the bottom line of the income statement usually is called net income or net loss, depending on whether it's a positive or negative number. The descriptive term for the bottom line of the income statement under IFRS is just profit or loss. Similar to US GAAP, international standards require a statement of cash flows. Again, similar to US GAAP, under international standards, cash flows are classified as either operating, investing, or financing. The US standard stipulates that cash outflows for interest payments and cash inflows from interest and dividends that are received should be reported under the operating section. Dividends paid to shareholders classified under financing. Under the international standards, however, there's more flexibility allowed there. Companies are allowed to report interest and dividends as either operating or financing cash flows, and interest and dividends received as either operating or investing cash flows. Interest and dividend payments are usually reported as financing activities, whereas interest and dividends received are normally classified as investing activities. I believe the last thing we're going to talk about in this presentation is interim reporting. Interim reporting is financial reporting for periods of less than a year. So typically, this, or a good example of this, is a quarterly report. The objective of doing this type of interim reporting is to enhance the timeliness of financial information available to external users, such as creditors or investors and potential investors. Because there's a lot of market movement during the entire year, if you only get yearly info, obviously by the end or as you near the end of that period, the information that you're using to make decisions is becoming more and more outdated. So obviously that creates an incentive to provide more timely financial information throughout the year. However, the downside to having the benefit of more timely information is that these interim statements that you see are, relatively speaking, more unreliable than the annual statements that you see, because obviously if you're doing them more often, to allow that to happen, you may not be able to, or in a cost-effective way, may not be able to provide quite as many assurances of the reliability of that information. So as with all accounting information, there's pretty much always a way to get more information. Now, whether that more information is worth the amount of effort that goes into it and the amount of value derived in that is generally, as you get further and further into the minutia and the details, it becomes more and more expensive, less cost effective, and overall just less effective. In general, the same accounting principles used in annual reporting are used in interim reporting, in general. There are a few exceptional instances when it doesn't make sense due to the nature of the shortened period, as you see here. Complete financial statements are not required for interim period reporting, but there are certain minimum disclosures that are required in order to keep with GAAP accounting that are mandated, obviously, if you're under the authority of the Securities and Exchange Commission. Remember also that when fourth quarter results are not reported separately in their own separate quarter, and they're only included as a part of the annual report, any material fourth quarter events, including year-end adjustments, need to be reported in disclosed notes to the annual statements. So that's it for this slideshow. Again, I will also post some quiz-like questions so that you have some examples of those as well before you take the quiz.